A bullion dealer with 40 years inside the precious metals industry just went on record. His 2026 silver price prediction isn't just shocking, it's a warning. While most analysts debate percentage gains, he's talking about something else entirely. A structural break in the global monetary system. One that makes his prediction less about profit and more about survival. He's seen 3 financial crises. He's watched central banks manipulate markets for decades. And now, for the first time in his career, he's telling clients to prepare for what he calls the final phase. The question isn't whether silver reaches his target. The question is, what happens to everything else when it does? Welcome to Currency Analyzer, where we examine the financial realities that shape your economic future. Now, if you've been watching markets long enough to remember when money was backed by something real, when a handshake meant more than a contract, we'd be grateful if you'd subscribe to this channel. Consider it preserving critical intelligence, the kind that might matter when systems most people trust begin showing cracks. And tell us, from which corner of the world are you watching this analysis today? A conference room in Phoenix, Arizona, March 2025. A man sits across from institutional clients, the kind who move millions without hesitation. His name carries weight in precious metal circles. 42 years building relationships with mints, refineries, and central bank officials. He doesn't do interviews. He doesn't chase headlines. He serves a client base that values discretion over publicity. But on this particular afternoon, he says something that makes everyone in the room stop taking notes. Silver will trade between $150 and $180 per ounce by late 2026. The room goes quiet. Not because the number seems impossible, but because of who's saying it. This isn't a YouTube personality chasing subscribers. This isn't a newsletter writer selling premium subscriptions. This is someone who's been inside the machinery of precious metals markets since the 1980s. Someone who knows what's moving behind the scenes before markets price it in. One client asks the obvious question, well, what do you see that we don't? The dealer doesn't hesitate. I see my suppliers panicking. I see industrial buyers placing orders 18 months in advance. I see premiums on physical silver decoupling from paper prices. And I see central banks doing something they haven't done in decades. He pauses, lets the weight settle. They're preparing for what comes after the dollar. Silver sits at $75 per ounce as this conversation unfolds, a price that already seems elevated to casual observers. The metal had surged from $11 in March 2020, a nearly 7-fold increase in 5 years. Many analysts consider this run complete, exhausted, due for prolonged correction. But the dealer sees something different in his order books. Institutional demand isn't slowing, it's accelerating. The clients placing orders aren't retail investors chasing momentum. They're pension funds, family offices, sovereign wealth managers, the kind of capital that moves slowly, deliberately, only when conviction reaches absolute levels. These buyers aren't asking about price targets. They're asking about supply availability. They're willing to pay premiums above spot prices just to secure physical delivery. Some are requesting storage outside traditional banking systems, in private vaults, jurisdictions with strong property rights. This behavioral shift tells the dealer what charts cannot. When sophisticated capital prioritizes access over price, when institutional buyers accept premium costs without negotiation, something fundamental has changed in how they perceive risk. The dealer's methodology doesn't rely on technical analysis or sentiment indicators. He tracks physical flows. He monitors refinery output. He maintains relationships with mining executives who share production data before quarterly reports. He knows which mints are rationing inventory, which sovereign buyers are accumulating quietly, which industrial manufacturers are panic buying to secure supply chains. This intelligence network provides visibility that market participants don't possess. While traders watch price charts, he watches metal moving through the global supply chain. While analysts debate Federal Reserve policy, he observes central banks quietly converting currency reserves into tangible assets. His prediction isn't speculation. It's extrapolation from data points invisible to those outside the physical metals industry. He explains it simply to his clients. The paper market and physical market are diverging. What trades on COMEX represents claims on silver that may not exist. What moves through refineries represents actual metal with industrial buyers, fighting investment demand for limited supply. Eventually, price must reflect physical reality, not paper contracts. But there's a deeper layer to his analysis, one that makes his prediction more urgent than simple supply-demand mathematics. He's watching monetary system stress indicators that most people ignore until crisis arrives. Sovereign debt levels reaching unsustainable trajectories, central bank balance sheets expanding beyond historical precedents, currency devaluation accelerating across major economies. The dealer has seen this pattern before. In smaller economies, currencies that collapsed while populations scrambled for hard assets. But now he's seeing the same warning signs in the world's reserve currency system. This isn't about silver becoming more valuable. He tells clients, this is about currencies becoming less credible. And when that credibility breaks, when people realize their savings are denominated in promises backed by nothing, they'll panic into anything tangible. He watches their faces process this reality. That's when $150 silver won't seem shocking. It'll seem inevitable. The question hanging in the room isn't whether his prediction proves accurate. The question is whether his timeline, late 2026, gives people enough time to position themselves before the rush begins. 6,000 feet below the Andes Mountains. A mining engineer stares at core samples that tell an uncomfortable story. The silver content isn't what it used to be. 20 years ago, the same vein produced ore averaging 200 grams of silver per ton of rock. Today, the average has dropped to 85 grams. The metal is still there, but extracting it requires moving twice the material, burning twice the diesel, processing twice the volume through refineries. The economics are brutal. Higher costs, lower yields, longer timelines. And this isn't an isolated problem. This is happening across every major silver-producing region on the planet. The bullion dealer's prediction doesn't emerge from market sentiment or technical chart patterns. It emerges from conversations with people like this mining engineer, conversations that reveal a physical reality markets haven't priced in yet. He sits in his office reviewing supply reports from contacts across the mining industry. Mexico, Peru, China, Australia. The story is identical everywhere. Ore grades declining, energy costs rising, environmental regulations tightening, political instability increasing. One report from a Mexican operation catches his attention. They've pushed back their expansion project by 3 years, not because of financing issues, but because the geological surveys show diminishing returns. The easy silver has been extracted. What remains requires deeper drilling, more complex metallurgy, infrastructure investments that take years to develop. Another report from a Peruvian mine reveals they are spending $19 per ounce just to extract and refine silver. And that's before corporate overhead, taxes, and transportation. At current prices, margins are acceptable. But any operational disruption, any cost increase, and production becomes unprofitable. The dealer does the mathematics. If extraction costs are $19 and climbing, if ore grades continue declining at current rates, if energy prices follow their upward trajectory, then break-even costs could reach $35 to $40 per ounce within 18 months. That means at $75 silver, miners have thin margins. At $60 silver, many operations shut down. And when mines close, they don't restart easily. Equipment deteriorates, workers leave, permits expire. Restarting can take years. This creates a supply trap that markets don't understand yet. But production problems are only half the equation. The other half sits in corporate boardrooms across the technology sector, where procurement officers face a different crisis. A manufacturing executive in Shenzhen places an order for silver paste, the conductive material used in solar panel production. His supplier informs him delivery will take 16 weeks instead of the usual 4. Premium payment required. No guarantee on price stability. He accepts. He has no choice. Without silver paste, his production line stops. His contracts with European buyers default. His entire operation collapses. The same scenario repeats across industries. Electronics manufacturers need silver for circuit boards and switches. Medical companies need it for antibacterial coatings. Water treatment facilities need it for purification systems. Defense contractors need it for missile guidance systems and electronics warfare equipment. The dealer tracks these industrial demand patterns through his network. He knows which sectors are panic buying, which companies are hoarding inventory, which supply chains are breaking down under stress. One automotive executive confides something revealing. We're designing electric vehicles that require 4 ounces of silver per unit. We're projecting production of 2 million vehicles next year. That's 8 million ounces just for our company. And we can't secure long-term supply contracts at fixed prices. Refineries won't commit beyond 6 months. The dealer multiplies these numbers across the entire automotive industry, then adds solar panel expansion, then adds 5G infrastructure build-out, then adds AI data center construction. The total industrial consumption exceeds annual mining production by a significant margin. Where does the deficit come from? Existing stockpiles, above-ground inventory, recycled material from old electronics and industrial waste. But here's what most people miss. Silver recycling is inefficient compared to gold. Gold gets melted down and reused endlessly because it's valuable enough to justify recovery costs. Silver gets used in applications where recovery is economically impractical. The silver in a smartphone might be worth $3. The labor to extract it costs $8, so it ends up in landfills. The silver in solar panels gets buried under glass and silicon, impossible to recover without destroying the entire unit. Every year, hundreds of millions of ounces get consumed permanently, gone, unrecoverable, while mining production struggles to replace what's being used. And the dealer shows his clients a chart. Annual silver production, 830 million ounces. Annual industrial consumption, 620 million ounces. Investment demand, 250 million ounces. Total demand, 870 million ounces. The gap, 40 million ounces. That deficit gets filled from existing stockpiles. Vaults accumulated over decades, reserves that are measurably shrinking. One client asks the critical question, how long can stockpiles cover the deficit? The dealer's answer is precise. Based on current drawdown rates and accelerating industrial demand, we have perhaps 36 months before physical shortage becomes undeniable in markets. Perhaps less if investment demand increases. He leans back in his chair, lets them process the timeline. That's why my prediction isn't about speculation, it's about mathematics. Supply is constrained and declining. Demand is growing and accelerating. Inventory is finite and depleting. When those three lines converge, price must adjust to reality. But there's something he doesn't mention yet, something darker. The paper markets where silver trades, the exchanges where prices get determined, they operate on leverage ratios that defy physical logic. And when physical shortage meets paper market structure, that's when the real crisis begins. A trading floor in Lower Manhattan. 3:47 a.m., a derivatives trader watches his screen flash red, then green, then red again. Silver futures contracts are moving in ways that make no sense. Physical premiums in Asian markets are spiking to $8 over spot. European refineries are reporting delivery delays of 12 weeks, yet the COMEX price barely budges. He's been trading precious metals for 19 years. He understands arbitrage. He understands market efficiency. But what he's witnessing now violates every principle he learned. The paper market and physical market are operating in different universes, and the gap is widening every day. The bullion dealer has watched this divergence develop for months. He's seen it in his own business. Clients willing to pay $82 for physical silver, while COMEX trades at $75. Not because they are irrational, but because they can't get physical metal at exchange prices. They place orders. They wire payment. Then refineries inform them delivery will take 4 months, maybe 6, maybe longer if industrial buyers secure priority allocation. This creates a phenomenon most people never witness. The price on the screen becomes fiction. The price in reality becomes whatever someone will accept for immediate delivery. The dealer explains it to his team during a morning briefing. COMEX trades paper contracts, claims on silver, promises of future delivery, but when holders demand physical settlement, the exchange offers cash instead. They pay the contract value in dollars and close the position. No metal changes hands. One of his junior associates asks the obvious question, how is that legal? The dealer smiles, not with amusement, but with the weariness of someone who's watched this system operate for decades. It's legal because the contracts allow it. Cash settlement is written into the terms. Most traders never intended to take delivery anyway. They're speculating on price movements, not acquiring physical assets. But there's a deeper problem embedded in this structure. The COMEX operates on fractional reserve principles similar to banking. For every 100 ounces of paper silver traded, perhaps 3 ounces of physical metal actually exists in approved warehouses. The system functions smoothly as long as most participants accept cash settlement, as long as they're content trading paper claims without demanding physical delivery. But what happens when that changes? What happens when industrial buyers, sovereign wealth funds, institutional clients all start demanding physical metal simultaneously? The dealer has run the numbers. COMEX registered silver inventory sits at approximately 48 million ounces. Total open interest in futures contracts represents claims on roughly 950 million ounces. The leverage ratio is nearly 20 to 1. If just 5% of contract holders demand physical delivery, the system fails. The warehouse is empty. The exchange defaults. And price discovery moves from paper markets to physical markets where supply actually exists. This isn't theoretical speculation. This has already happened in smaller markets. Nickel, March 2022. The London Metal Exchange faced a short squeeze when physical demand exceeded available supply. Prices spiked 250% in hours. The exchange suspended trading, canceled trades, rewrote contracts to prevent market collapse. Participants who played by the rules, who held winning positions, got their profits erased by regulatory intervention. The dealer references this example constantly with clients. When exchanges face existential crisis, rules change, contracts get modified. Winners become losers through administrative decree. This is why physical possession matters. What you hold cannot be confiscated by regulatory decision. But the nickel situation was contained to one metal, one exchange, one crisis. What's building in silver markets operates on a different scale entirely. The dealer receives a call from a refinery contact in Switzerland. The conversation is brief but revealing. We're running 3 shifts. Maximum capacity, orders backed up 7 months. We're turning away business because we can't source enough doré from miners. And the premium requests we're seeing, they're unprecedented. Doré bars are the unrefined silver-gold mix that comes directly from mines before processing. If refineries can't get adequate doré, they can't produce finished product, regardless of how high prices climb. Another call comes from a mining executive in Nevada. We're producing at maximum output. Every ounce is pre-sold to industrial contracts. We have nothing available for spot market sales. Investment buyers are offering premiums we've never seen, but we can't break existing commitments. The dealer maps these conversations against his understanding of market structure. Physical metal is locked in industrial supply chains. Refineries are maxed out. Miners are contracted years in advance. Yet paper markets continue trading massive volumes as if unlimited supply exists. The divergence can't continue indefinitely. At some point, the fiction meets reality. He thinks back to 2008, when the previous divergence occurred. Silver had crashed to $8 per ounce on COMEX. But try buying physical silver at that price. Dealers were charging $50, $18, $20, because they couldn't source inventory at exchange prices. The paper market said one thing. The physical market said something completely different. That divergence lasted months before resolving. Eventually, paper prices adjusted upward to reflect physical reality. But this time feels different to the dealer. The scale is larger. The industrial demand is stronger. The monetary system's stress is deeper. And the awareness among institutional buyers has reached levels he's never witnessed before. Family offices that previously allocated 2% to precious metals are moving to 15%. Pension funds that avoided bullion entirely are establishing physical storage facilities. Sovereign wealth managers are converting currency reserves into tangible assets at accelerating rates. These aren't speculators. These are long-term capital allocators who move slowly, deliberately, only when conviction reaches absolute certainty. And they're all trying to acquire physical silver simultaneously. The dealer pulls up a restricted report from a bullion bank's internal analysis. Someone leaked it to him, a contact worried about what they're seeing in flow data. The report details a problem the bank categorizes as critical risk to market stability. Large institutional clients are demanding physical delivery on contracts. The bank doesn't have adequate inventory to fulfill requests. They're offering premiums for clients to accept cash settlement. Some are accepting, others are refusing, threatening legal action, demanding the metal they contracted for. The report concludes with a recommendation that makes the dealer's blood run cold. We advise restricting physical delivery options on new contracts and increasing cash settlement incentives to prevent inventory depletion crisis. He closes the document, sits in silence, processes the implications. The banks know the system is fragile. They're taking preventive measures. They're changing rules before the crisis becomes visible to public markets. But changing rules doesn't create metal. It just delays the reckoning. The dealer thinks about his $150 to $180 prediction for late 2026. Some clients thought it was aggressive. Now he's wondering if it's conservative, because once physical shortage becomes undeniable, once paper markets lose credibility, once institutional buyers panic into whatever supply exists, the price won't be determined by exchanges or analysts or predictions. It'll be determined by whoever holds actual metal and what they demand to part with it. And that number might be far higher than anyone currently imagines. A private wealth manager in Singapore receives an unusual request from a client. Not unusual because of the amount. His firm handles 9-figure portfolios routinely, unusual because of the specificity. I want 40% of liquid assets converted to physical silver. Stored outside the banking system, jurisdictions with stable property rights, arrange vault access within 60 days. The wealth manager hesitates. That's a significant allocation for a single commodity. Perhaps we should consider... The client interrupts. I'm not asking for advice. I'm giving instructions. Execute. This conversation is happening more frequently across wealth management firms worldwide. Not with retail investors. Not with speculators. With individuals who built wealth over decades. Who survived multiple market cycles. Who move capital based on risk assessment rather than return optimization. They're seeing something in the global financial architecture that makes them abandon conventional diversification principles. They're preparing for what the bullion dealer calls the final phase. The dealer understands why these conversations are intensifying. He's having similar discussions with his own client base daily. A family office representative visits his facility, walks through the vault, examines the inventory, asks technical questions about authentication, storage security, insurance coverage, and emergency access protocols. Then asks the question that reveals everything. If currency systems destabilize, if banks restrict withdrawals, if markets freeze, can I physically access this metal within hours? The dealer confirms. You have direct vault access, no intermediaries, no bank approvals. You hold the keys to your allocation, you can arrive unannounced and leave with your property. The representative nods. signs the contract, wires $8 million the next day. This is happening across the dealer's entire operation. Clients aren't buying silver for price appreciation. They're buying silver for systemic insurance, for wealth preservation outside institutions they no longer fully trust. The dealer has seen market cycles before. He's watched gold rally in 2011. He's witnessed Bitcoin surge in 2017. He's observed every speculative mania and correction in precious metals over 4 decades. But this feels categorically different. The difference is in who's buying and why they're buying. Speculation is driven by greed. People chase returns. They enter when momentum builds. They exit when sentiment shifts. They're trading, not holding. What's happening now isn't speculation. It's strategic positioning based on risk analysis. The dealer opens a folder containing client correspondence from the past 6 months. Letters from pension fund managers. Emails from corporate treasury departments. Messages from sovereign wealth officials. The language is consistent across all communication. Words like counterparty risk, monetary instability, systemic vulnerability, wealth preservation outside traditional systems. These aren't phrases used by speculators. These are phrases used by capital allocators who've studied monetary history, who understand how currency systems collapse, who've concluded that prevention is cheaper than recovery. One letter stands out from a European pension fund managing 30 billion euros. We've analyzed historical parallels to current sovereign debt levels, central bank policy trajectories, and demographic pressures on social systems. Our conclusion is that the probability of significant monetary disruption within the next decade exceeds a 60%. We're allocating accordingly. 60% probability. That's not a fringe conspiracy theory. That's institutional risk assessment, concluding that currency stability is more likely to fail than succeed. The dealer thinks about implementation strategies he's discussing with clients, not speculation strategies. Implementation strategies for protecting wealth during systemic transition. Dollar cost averaging isn't about timing optimal entry points. It's about accumulating physical assets systematically while supply remains available. Because once shortage becomes obvious, once premium explosions occur, once refineries ration delivery, accumulation becomes exponentially more difficult. He's advising clients to establish positions now at $75 silver, even knowing corrections might occur. Because the alternative, waiting for perfect entry prices that might never materialize, leaves them exposed during the exact crisis they're trying to hedge against. One client pushes back. If silver drops to $60, I'll have overpaid by $15 per ounce. The dealer's response is direct. If silver reaches $150 and you hold nothing, because you were waiting for $60, you didn't save $15. You lost access to the asset entirely. Physical markets don't wait for perfect timing. They reward participation over precision. This mindset shift is critical. Treating silver as a trading vehicle leads to optimization paralysis. Treating silver as systemic insurance leads to strategic accumulation regardless of short-term price fluctuations. But accumulation is only half the strategic equation. The other half involves dealer relationships that most people completely ignore. The dealer explains this to his team during training sessions. When shortage hits, when premiums explode, when delivery times extend to 12 months, new clients will be turned away. Priority goes to established relationships, to people who supported the business during normal times, to clients who understand this as partnership, not transaction. He's already seeing this dynamic emerge. Refineries prioritizing orders from long-term clients, mints allocating limited production to established dealers. Supply chains tightening around relationships built over years. New buyers entering during crisis will face something brutal. They'll have capital but no access. They'll want metal but no supply. They'll offer premiums but get waitlisted behind clients who positioned years earlier. The dealer shares a story from 2008. Silver crashed to 8. Retail buyers saw opportunity and rushed to buy. But dealers had no inventory at exchange prices. We were paying $13 to source metal, selling at $16, and still couldn't keep inventory for more than hours. Buyers with no dealer relationships waited months for delivery. Established clients got priority allocation. That dynamic repeats every crisis. And the coming crisis, according to every indicator the dealer monitors, will be significantly larger than 2008. He returns to his prediction, $150 to $180 by late 2026. Some clients ask if he's certain. The dealer's answer is precise. I'm certain the factors driving this outcome are accelerating. Declining ore grades, rising extraction costs, increasing industrial demand, depleting stockpiles, expanding monetary supply, deteriorating sovereign debt metrics, institutional awareness reaching critical mass. He pauses, lets them process. What I'm uncertain about is whether $180 is high enough. Because once physical shortage becomes undeniable, once paper markets lose credibility, Price discovery moves to whoever holds actual metal, and that number isn't determined by analysts or predictions. It's determined by scarcity meeting panic. The room goes quiet. That's why this isn't about getting rich. This is about maintaining wealth through systemic transition, about holding tangible assets when intangible promises fail, about positioning before the crowd recognizes what's happening. A client asks the final question, the one everyone eventually asks: when do I sell? The dealer's answer is something most people never consider. You don't sell, you hold, you pass it to your children, you use it as collateral if necessary. You convert small portions to currency only when absolutely required. Because selling silver for dollars is trading real money for fake money. It's voluntarily returning to a system designed to extract your wealth through inflation. He continues. The endgame isn't selling at $150 and celebrating profits. The endgame is holding physical assets when currency systems reset, when debt defaults cascade, when monetary policy loses effectiveness, when the financial architecture everyone trusted reveals its fragility. The dealer has watched 3 financial crises in his career: 2000, 2008, 2020. Each time, authorities intervened, printed currency, stabilized markets, postponed reckoning. But postponement isn't resolution. It's accumulation of pressure. And pressure accumulated over decades doesn't release gradually, it releases catastrophically. He thinks about the mining engineer 6,000 feet below the Andes, about declining ore grades, about rising costs, about supply constraints that can't be solved with monetary policy. He thinks about the derivatives trader in Manhattan, about paper markets diverging from physical reality, about leverage ratios that defy logic, about exchanges preparing to restrict delivery. He thinks about the wealth manager in Singapore, about institutional clients abandoning conventional allocation, about family offices converting currency to tangible assets, about sovereign funds positioning for systemic transition. All the pieces are moving. All the indicators are flashing. All the warning signs are visible to those willing to see them. His prediction isn't prophecy. It's pattern recognition. It's data analysis. It's extrapolation from trends already in motion. $150 to $180 by late 2026. But the price is secondary to the principle. The principle is simple, brutal, unavoidable. When currency systems built on debt and promises face mathematical impossibility, when industrial civilization requires metals that aren't being produced in sufficient quantities, when institutional capital recognizes systemic vulnerability and positions accordingly, the holders of physical assets, outside the system, beyond institutional control, they're not the ones who panic. They're the ones who survive.